While for many of us, investing in index funds or passive investing is the way to go, I previously discussed why active investing can beat the market, although at a higher risk. One asset management company that has been making waves lately is the ARK Invest. What sets ARK Invest apart is its focus on innovation or disruptive technologies, which aligns more closely to a growth style of investing. Spearheaded by founder Catherine Wood, ARK Invest offers a number of different strategies to tap into these disruptive technologies through different wrappers as shown here. These technologies range from next generation internet to space exploration, and as you can see, most of them are available through an exchange traded fund or ETF for short, meaning you can trade those easily on a stock exchange. Their most popular ETF is undoubtedly their flagship ARK Innovation ETF, ticker symbol ARKK, whose returns have been nothing short of spectacular. Launched on 21st of October 2014, ARK Innovation ETF comprises typically of between 35 to 55 holdings and famously included Tesla, which represented a significant proportion of its portfolio and still is to this day. And as we all know, Cathy Wood turned out to be right about this choice, with Tesla, which was worth about $45 at the time of the fund's inception, rose to about $740 today, which represents over 16 times its original value. Overall, however, the fund has delivered huge returns since creation. So for comparison, this is how the S&P 500 performed since 2015. Roughly 103% gains. Not bad over a 6-year period. The Nasdaq 100, which typically outperforms the S&P 500, yielded a 231% return, more than twice the S&P 500 return. But this is less than half of what the ARK Innovation ETF delivered, which is a whopping 516% returns. As expected, these phenomenal returns made Cathy Wood a superstar in the world of investing. But her fame did not just extend to the circle of institutional investing. Many retail investors were also impressed, and today Cathy Wood and to some extent ARK Invest have gathered a strong following. And if you go to their website, they even have a merchandise shop, which apparently opened due to popular demand, and the profits of which goes to charity, by the way. And if you want to join the movement and invest in ARK Invest products, unfortunately for UK residents, they are currently not available. So the next best alternative is either replicating their portfolio or perhaps copying an ARK Invest SPY on Trading 212. Replicating an ETF, as I explained in one of my previous videos, link here, is possible and can save you the expense ratio, but it can be tedious, especially if the fund holds a large number of assets. Copying a Trading 212 pie tracking the ETF might overcome this, but you'd have to assume the pie owner is constantly updating their pies. An alternative to ARK Invest and something more local is Baillie Gifford, whose flagship Scottish Mortgage Investment Trust can give ARK Invest a run for its money. Unlike ARK Invest, which has been around since 2014, Baillie Gifford has been operational since 1908. In fact, there's a short video that explains what they've been doing and their approach to investing. I highly recommend that you watch it. The link is in the description, so feel free to pause this video and open the link in a new tab so you don't forget to watch it or forget to watch my video. Baillie Gifford has a wider variety of funds, including anything from the Monks Investment Trust to health innovation. The Scottish Mortgage Investment Trust, which unlike the name suggests, is neither focused on Scottish investments nor mortgages. It's a bit like Boots that doesn't sell any shoes, or how Currys doesn't sell any food. But at this point you may pause and wonder, what is an investment trust? In simple terms, it's a company which holds assets including shares and is quoted on the stock exchange. The closed-ended feature of an investment trust means that there is a fixed number of shares issued for the company, meaning that if investors were to sell their investments, the fund manager does not need to sell any shares to give them back their money. Remember this because you're not buying the shares of the fund's investment directly, but instead you're buying shares in the fund itself. This distinction is important as we've heard stories of how mutual funds ran into liquidity problems once investors decided to pull out, usually at the worst possible time, leaving the mutual fund and managers scrambling for money. The other advantage of an investment trust is that they can set aside 15% of their income to buffer for the hard times. Let's take a look at the performance of the Scottish Mortgage Investment Trust, or SMT for short. Over the past 30 years, the fund has returned phenomenal returns. In January 1990, a share would cost you 27p, and in January 2021, this was valued at 1245 pence, representing 46 times the initial value. This translates into an annualized return of 32%, an insane compounding rate. But in the interest of a like-for-like comparison, I went ahead and compared the Scottish Mortgage Investment Trust to ARK Invest, as you can see from the graph. Over the last 6 years, ARK delivered 516% as mentioned earlier, but SMT was behind but not by much and still delivered huge returns. And yes, in terms of pure performance over the last 6 years, ARK takes the edge here, but ironically, this is where ARK Invest Group falls short, although through no fault of their own. They simply don't have the track record to demonstrate that they are able to achieve these stellar performances consistently. Investment history is full of fund managers who shine brightly for a few years and slowly fade, or even worse, crash and burn. And when it comes to active investing, you need to be particularly careful, as statistically an index fund beats 90% of active fund managers. The other benefit that SMT has over ARK is that it allocates 16% of its portfolio towards private equity, which is usually difficult for the average retail investor to access. For example, the fund holds almost 2% of its portfolio in ByteDance, the company behind TikTok. So, while ARK holds up 55 investments, SMT holds well over 100 investments, including private equity. So there's greater diversity. To be fair though, private equity comes with higher risk. The other powerful tool that SMT has in its arsenal is gearing. It has the ability to borrow and amplify its performance multiple times for the better or for the worse. It is effectively a leverage investment, and as I've mentioned before, debt is a double-edged sword. Finally, last but not least, is the expense ratio. ARK has a 0.75% expense ratio compared to 0.36 for SMT, so less than half the cost. Now, I don't think the expense ratio should be the deciding factor, but it certainly weighs in over the long run. So, what's the verdict? Well, ARK has personally posted some mind-boggling performance, but lacks the proven track record to demonstrate whether high returns is sustainable. SMT, on the other hand, is from a well-established institution, and the investment wrapper allows private equity investment and gearing, both of which come with potentially higher upsides, but at the expense of higher risk as well. And this concludes my video. I hope you find it useful. If you appreciated my efforts, you know what to do. As always, thank you for watching, and until next time.